Happy Friday, everybody. Welcome to the 7th edition of Real Assets Weekly. With me, as always, my esteemed co-host, Jimmy Wang. Jimmy, what's up, my man? How are you?
Good morning, Turtle. Another beautiful
Good.
Friday. We're here to talk about some real estate. Coming out
Yeah,
of the NAREIT conference, got a lot to talk about, and it's a new bull market, right?
that's right. That's right.
New bull market for bag holders.
That's right. And Don
Yeah.
Corleone is back. He's back from a meeting of the minds. The seven families met. I guess they call it NAREIT, is what what some people call it, but we call it the meeting of the seven families. And with that, it's Friday. David, how are you?
I'm great. I love it. The meeting of the seven families. That's fantastic. We're doing great. Thank
That's
you.
good. That's good. And so cool. So today's podcast, we can really focus on, what we've kind of this thread that we've been talking about a little bit, which is the disconnect between private and public, listed real estate versus private real estate, private REITs, but private real estate generally. We got some charts to look at. We've got some stocks to look at. And very exciting. David has an ETF that'll be coming out. Maybe we could start with this. So David's got an ETF coming out, I believe Tuesday. It lists ticker symbols PRVT, is in private, and it actually aims to do just a little bit of that. So maybe it actually aims to capture, some of the, aims to take advantage of that disconnect. So maybe David could tell us a little more. Jimmy and I will pepper him with questions, and let's have some fun. Happy Friday.
Yeah, thanks so much. And again, it's a pretty easy story to tell because the private REIT vehicles have assembled some wonderful portfolios, Class A assets, best sectors, best markets. And so what we're saying is, you can get that private REIT allocation, but at current market valuations. With the publicly traded REITs trading at a 20 to 25% discount to NAV, there could be, as we play into this potential recovery, a better upside versus potentially some of the private vehicles, whose NAVs might reset as valuations come more in line through appraisal. And so we are seeing this potential opportunity here, bringing the best in class portfolios in these private REITs, but in a more liquid ETF wrapper with a much more manageable fee structure and 59 basis points compared to what you might see in some of the other vehicles that are out there.
I love it. That's maybe a great just kind of point to kick it off with.
And looking at this slide, this is the reason why, because we really have not seen any time where there's this major divergence to the extreme that we're seeing it now in the world of private versus public. And so at some point that divergence has to converge back to normal. Either the public guys rally up or the private guys are going to come back to earth. But at some point, that divergence is going to come back more in line. And that's a great chart that you're showing there.
Yep.
Probably need to update it since it's close to a year old from Janice. But obviously, a picture tells 1,000 words, and this provides a really good story as to why we're bringing this vehicle to market.
I love it. I love it. A REIT ETF, or excuse me, an ETF thesis in a single graph, if ever there was one. I think this graph, not to like nerd out on these graphs, we can kind of go through them over time, but really quick. I mean, I thought about this, my initial, I kind of want to, there's a lot to dig into there, and really interested to see kind of what Jimmy's initial thoughts are on that. We were Jimmy and I were hitting the tennis ball a little bit over text or DM about what we thought your top holdings might be and stuff. But I think even just starting here, a lot of people maybe that I've talked to about potentially this opportunity in publicly traded REITs, it seems like a lot of folks, and we touched on this last podcast as well, is a lot of folks are just skeptical of paper real estate, maybe, right? Like, paper real estate kind of sucks. Fair, maybe, or I can appreciate where that's coming from. You don't control the asset. It's kind of like owning a business versus owning a share of stock, right? However, as this scatter plot shows, look, the correlations of these asset classes is very high, right? And so to have this disconnect that we had, as this graph I think shows a great job, or I'll show you one more really quick right here. Here you go. Here's the opportunity, assuming all these figures are right and stuff. I mean, the opportunity is pretty neatly laid out for you right there. So maybe Jimmy, maybe you could tell us a little bit like what I tagged you in the thread last night. I was just kind of interested to hear what do you think about this premise? Maybe just start there, like kind of your initial handicapping or what do you think about the premise that there's an opportunity here in these publicly traded REITs, especially on a relative basis to privately held real estate, commercial real estate?
Yeah, of course. Good morning, and I've got so much to talk about here. On the surface, the discount to the private NAV looks real. But we discussed that the liquidity in the market for private market transactions is not there. And I think there's a healthy dose of skepticism about what the real value is. Now, I got a funny story that's going to lead into what I want to talk about. In 2007, when you see in the middle of the graph, right as things were blowing up, if you recall, in 2006 and 2007, as the Fed started hiking interest rates from a higher base to an even higher base versus today, the public market and just the broader real estate market was financing properties with bullish valuations with negative debts, debt carry. So a building was trading at a 4 cap and you were financing with 5% debt. How do you make the math work, right? You're banking on capital appreciation, and what else? But as we quickly saw, from 2007 to 2009, liquidity dried up. The fundamentals worsened, particularly for financial tenants and everything that we've come to know subsequently. I was in school at the time, and I was working for a firm out in Princeton, and a lot of what we were doing was figuring out what the value of a minority interest in a business was, whether this was a hedge fund carried interest for tax purposes or whether it was for secondary private equity valuations. And now what we haven't seen quite so, because things are being gate kept right now, is as liquidity has dried up in the private market and buyers eventually need to get out, right now there's a happy dance. We lie and pretend, we blend and extend, we do whatever we have to do, we don't want to take the mark. There comes a time where you have an LP, and this is kind of the counterparty basis risk that we're going to talk about as we progress through the cycle. There comes a time when the LP has to get out for whatever reason, and the other LPs don't want that mark to market. So typically what happens is those, minority shareholders go out to the secondary market, and they're typically transacting at pretty steep discounts. Now, again, I don't know where the opportunistic buyer is today. I think a lot of people are still waiting for the shoe to drop, whether it's single family, whether it's commercial real estate. So we need to see some of those transactions hit the market. But it's no surprise that public markets, because of the liquidity features, they lead both coming down and coming up. In fact, for me, I think the best time to buy real estate is when public REITs are trading at a massive premium. We saw that in 2009, 2010, when the private market was still really beat up. We had 4 or 5 years of this hated rally. People were concerned, but the public markets had already priced in that things were going to turn around, and these companies that, to David's point, they have great assets, great management, great balance sheets. They were able to take advantage of some of the disconnect and buy distressed properties in the private market when they had a premium cost of capital. Today, certainly we're not there. And like I said, I think there's a checklist of things that continue to happen for us to feel a little bit closer to the bottom. That's my personal opinion, right? We joke about how financial advisors and real estate brokers are this ultimate pro-cyclical indicator. We need to see real estate brokers decline, right? People have to leave the business. We need to see real pain, in my opinion, again. So we're doing this dance right now.
Jimmy, you bring up a great point, because that's one thing we've been talking about frequently, is that there's just been no transactions. And so because the transaction market has been very quiet, it's really hard to get a real true sense of what the market is. There's really only one sector out there right now that has a mark, and that's self-storage, because of the bid that's going on between Extra Space and Life Storage. So we know what those properties are worth based off of what the public bid is. Now, there has been stories in the past couple of weeks about the private REITs selling the JW Marriott down in San Antonio, as well as there was a story that came out yesterday that they're selling an asset in Atlanta that they had acquired from preferred apartment communities upon the closing of that merger. And let me make sure I have my numbers right here as I share this with you. But, just kind of as a gauge of where things stand, again, this comes from the Atlanta Business Journal that I'm going to share with you. Where is it? Sorry.
Yeah, no problem. I can make you
go ahead. Yeah,
I can make you co-host too, so you can share your screen.
No, I'm just going to read the article once I
yeah.
see the. Here it is. Okay, so they're marketing 3 Ravinia Drive in Dunwoody. They acquired it from Preferred Apartment Communities and the merger. It's expected to trade for $175, and Preferred paid $210.1 million in 2016 to acquire it. And so, again, it's not worth $200. I don't know what it was worth at the time that the deal closed with APTS, but there's a price point that there's potentially an office building that's going to be sold at, let's say at a discount to get it off the books.
Yeah, I mean, if you're the equity holder there, what's your mark? Maybe it's a 50% haircut, right? On a 215, 216 deal, how much debt are you putting that on that? So it's, when the sellers have to sell, and then again, we'll maybe even talk about the debt financing market later, but you hear about the CMBS market drying up, you hear about high yield market drying up. The REITs have the benefit where they're tapping unsecured debt. They're usually better or they're lower levered, but these private funds and these private platforms are holding on to quite a bit of amount, of debt. I don't think there's zeros, but I think you've seen some notable people on Twitter say, hey, it's something like over 60% of the office holders in New York City are underwater now. It's, if you had to mark the market today and fire sale your company, that's probably right.
Jimmy, in our replication, we're saying that the debt to gross asset value for our universe that we're putting in the fund is around 26%, while the current private REIT structure is around 45 to 50. So,
yes.
There's definitely
at their inflated NAVs.
And there's a definite disconnect there, and we kind of walk through some of that. We have access to a white paper. There's an independent white paper that's being finalized right now that kind of highlights a lot of this stuff. Turtle, go back to that chart that you had. Was that a Janus chart that you had up on the screen?
Yeah, it's all from Janus. Yeah,
that's a great chart. I mean, again, like for me, for what we're trying to do, I love that chart. I mean, again, it just proves, the private guys they're very smart management teams. They know a lot of what's going on. You know what I mean? They have asset level knowledge, market knowledge. They monitor large portfolios that under their umbrellas. And so we're able to learn a lot from those guys in their quarterly 10Q filings of what they're doing. And I think an interesting thing that we need to start posing. Let's talk about this office transaction in Atlanta as an example. By them making that transaction in Atlanta, it raises one of 2 questions. Are they doing the transaction because it's a thought in the change of the thesis of what's happening in office or Atlanta? Or is it because it has to satisfy liquidity needs? Now, clearly, they're not going to answer what they're using the proceeds for. But if they're going to go and monetize, let's say, gaming and data centers, the stuff that's quote unquote in the money, you would assume it's for liquidity purposes because that sector remains strong. If you're selling off, let's say, New York office, it's because it's potentially, again, and I'm not saying they're selling New York office necessarily, but it could be a change in the thesis of the sector, right? So, any transaction that they do gets closely reviewed with the microscope. And now it obviously gets broken up even more because now you have to ask, is this because of liquidity purposes or because of a sector thesis change?
Right. If they're selling their good assets, it's not coming from a position of strength. Basically, it's kind of the read through there. So no, I mean, I think so. So said another way, kind of big picture, something like something like PRVT or a portfolio of commercial REITs. Well, for sure, this right. Like if we could, the perfect or what I think would be a layup trade. Tell me where you disagree with this being a layup, Jimmy. Would a Granada would be if you could short if you could short private real estate funds marked at par and get long something like PRVT. I think I think we'd all do that all day long. The question is that that's obviously very difficult. You can't really do that. So the question is, as a standalone trade, is the index, or the index that these private REITs, or the composition of what they're buying, is that itself attractive?
Yeah, and I would say that it is, because again, we're replicating, the best allocations of these guys. And so, it is predominantly residential, industrial, gaming, data center type stuff. There's other stuff that these guys own, like looking at our universe, it's going to be like less than 3% of the index each, of like lodging, retail, office, healthcare, storage. For us at Armada, remember, we had our residential fund, and now we're opening it up to a whole bunch of other sectors. Because again, remember, these guys have acquired Class A assets and Class A markets, the best of the best type of stuff. And I'm a big believer of imitation as its sincerest form of flattery. We're trying to bring that great allocation to all investors in just a more cost-efficient ETF wrapper and in a more liquid vehicle that frankly doesn't face gating issues that you're seeing in some of those private vehicles.
You're the DBMF of private real estate, basically. If you guys caught the Top Traders Unplugged DBMF podcast argument, there was Andrew Beer and one of the big trend followers. It was really good. A lot of thoughts on replication, right? Just replication as a strategy, and fee reduction as alpha. Can you call, if I can give you the same portfolio as something else, and I can give it to you at a less cost, is that alpha? Who cares? Is that the right word for it? I don't know. It's better. I'll tell
money
you that.
Money is money, and if we're able to save investors, half the going in cost, let's say, or over the course of the life of the investment, which winds up being like 3% a year, that's some serious quote unquote savings in investors' pockets that they can use for other funds, and the vehicles aren't making those fees off of you.
So how closely does maybe talk to us about how you're going about building out the portfolio. So is there an index, and then you're using active management to overweight, underweight within the index? And how close is your index to something like XLRE?
So it's tough because there is no true index for what these guys are trying to do. We're basically kind of taking their quarterly filings and then layering it with publicly traded REITs that best make up that portfolio. So for us, I would say that we're a 60% Sunbelt exposure. We have a bunch of stuff in the coasts, some stuff in the mountains and Midwest, but it's again, it's going to be very resi heavy, very industrial heavy. Looking at our holdings, it's going to again, it's the Vicis of the world because of the relationship with Vici. Single family rental, so American Homes and Invitation Homes, Prologis, East Group, Rexford, some of the biggest industrial players that frankly blanket both the country and the world because of what Blackstone has across the globe. We're trying to bring it as, again, like I said, make it as close to what you're finding in these vehicles, whether it's Blackstone, Starwood, KKR. They all, again, kind of have that same layout of the portfolio. Our job is frankly just to try to bring the best of the best. So look, there's 19 apartment REITs, let's say. Do we need to have all 19 apartment REITs in our fund? No, we've been able to, like I said, get this portfolio to 50 names. So our PRVT is just 50 names in the basket, but our top 10 holdings are going to be like 70% of the portfolio because it best represents what that entire portfolio looks like as far as what they're overweighting as well.
Love it. We think about all this, Jimmy.
I think the charts still look awful. I think PRVT is going to do great, for what it's intended to do. But all the questions remain. If we hike further, if we maintain further, you can get a 12, 13-month CD now for 5.4%. And that's real institutional capital deployment. You're not going to find going in yields unlevered at that type of cap rate today for people who actually want to transact. So if you're an institution, you have to put in $100 million, $250. What are you going to do? And
call me.
Yeah, we're gonna call David Auerbach. But management teams have hard decisions to make. Earlier, before we started recording, we were talking about some Navy takeaways. I'd love to pick David's brain a little bit on that. But then I think as capital allocators, with the uncertainty, right? Again, I joke, it's a new bull market. Between student loan payments resuming, all the macro data inflecting downward, we have some more, heavy sledding to do. So it's I don't think the visibility is great right now,
Well,
and
Jimmy,
there's a big discount rate to that.
you comment about, he's like, boy, that chart sucks. And like talking to management teams at NAREIT, that's the one thing that every single person basically said was, boy, our stock price is just, it's in the tank right now. We can't focus on the stock. We just got to focus on fundamentals. We got to focus on continuing to grow revenues, continuing to cut expenses, growing NOI, keeping our eye on the ball. Stock prices will recover when they recover, but like for some of these guys, I'm not exaggerating. We heard the word strong. Like I was joking with the guy, I'm going to title my research notes strong, because that's all we heard from all of these guys. Strong fundamentals, strong recovery, strong summer leasing season, strong.
Thesis intact.
But it's not reflected in the stock price.
Yes.
And so again, you have to look at the bigger narrative that's going on out there. And like New York office. Yeah, it's a tough situation, but these guys are, signing office leases. New York residential, the rental market is one of the hottest markets in the country, showing up on the top of everybody's lists. And so at some point, again, not knowing anything, but you would think, who wants to work in a 500 square foot apartment where a bed touches 3 walls 5 days a week? You're going to go stir crazy. You're going to want to go back to the office building. And as another example, this is a separate note. I was in northern Wisconsin last week at a trip, and I happened to catch up with a friend of mine who runs a firm called Pillar Booth. I don't know if you guys have ever heard of Pillar Booth, but Pillar is an enclosed office workspace. And Pillar is working with the office landlords and the office tenants, especially in the the high profile markets like New York, San Francisco, et cetera, putting in these booths to encourage people to come back to the office so that you can still feel safe. You're in an enclosed workspace and you're able to grow the platform. But they're also working with apartment landlords who are doing the same thing for many apartments that have tenants that are working from home, residents are working from home. Again, in the amenity center, here's a Pillar work booth. You can go in there, do a phone call, have a meeting, kind of a quiet space. And so what I'm trying to imply is these landlords are trying to, and tenants are trying to figure out any and all angles possible to drive foot traffic back to those office buildings. We know that, Friday, I think I saw the number on CNBC this week. I think it was according to Castle that there's less than 20%. It's like 19.1% of the folks are in the office on Friday in New York City. Like literally 1 in 5 are in the office. And there's other cities that obviously reflect some of that. But during the midweek, those numbers are picking up. They are creeping up slowly. Is it ever going to be 100% occupied again? I think we all agree the answer is no. It will never be 100% occupied again, because we've proven that work from home is here to stay and it does work. But in the same breath, you'd lose out on that collaboration. Like, dude, if the 3 of us were doing this together in person, sitting around a table, the dynamic and vibe and collaboration we'd have would be 10x what we're trying to do on a Zoom here. And so, there is that desire to go back. I just think it's going to take some time. Some of the Wall Street firms are making more and more mandates in place. We talked to people from JP Morgan, RBC, some of the big bank guys that are, really forcing people's hands to go back to work.
No, I think it makes a lot of sense. And, just from a standpoint of, from the discount to NAV, like, I guess, can you talk about that a little bit? Like, so if it seems like there's different ways to monetize these assets. And if they truly are trading at these big discounts to NAV, there should be a way for us to make money. I mean, can we just make money on asset disposals or something? But it doesn't seem like, maybe you guys can talk about that. Like what's the track record of these management teams able to monetize discounts to NAV? Has that been a profitable strategy for REIT investors to buy stuff at a steep discount to NAV? Or is it all just kind of a fugazi anyway?
I'd like to maybe take a quick stab at it.
Please.
So the management teams will tell you, especially the ones that have been successful through the cycles, like EQR, which is high graded its portfolio multiple times.
Yeah.
Academically, the REIT structure seems pretty simple, right? If you're
Right.
trading at a premium cost of capital, you want to acquire, you want to be accretive, you want to grow your platform, you get paid more, everyone wins. If you're
Right.
trading at a discount, you liquidate, right? You liquidate because the market's saying your portfolio is worth 80 cents on the dollar, which is what it's saying today. Now, is that dollar real? Is that dollar obtainable? Although you have shareholders that are more opportunistic, that I think want management teams to signal, right? If you're trading at a unjustified discount, let's say, according to an investor, and you want to narrow the gap, incrementally, the best use of your capital is to dispose of assets. Now, companies typically don't want to sell their best properties. It makes your company weaker. They want to sell their bottom 10. There's a routine culling. Now, every once in a while, there might be a outsized opportunity to do something very strategic in nature, to go private, to do something different. But we're, again, in this dance. If you're a company that's trading at a 20% discount to NAV, which you think is temporary, are you going to sell the trophy asset, right? Are you going to sell the crown jewel of the portfolio to realize, to satisfy a short-term shareholder demand, right? And even if you do, how effective is that signaling? Are you swimming upstream? So we're in this point now where, even when you have individual asset sales, to David's point, we don't know if it's liquidity based, if it's opportunistic. But we do know that when there is a healthy dose of market skepticism, you don't get paid to sell your assets unless you're going to take out your portfolio and go private. You don't get paid to raise guidance and try to wow people with FFO growth if you're not going to get rewarded for it. So we're in this dance right now. Everyone's dancing, but just keep your head on the swivel.
I would love to hear David's reaction to that. It seems like some of the same problems you might run into buying, triple nets, right? Or excuse me, what do they call them? But you're buying stuff at discounted book value if you're buying regular stock. You don't control the management team, so you don't control the distributions. So that could sometimes be an issue. In the background, we have some Google Earth renderings of Essex, EQR, and AVB's properties, some highlighted properties we paid a guy on Fiverr to make for us, just for fun. But yeah, go ahead, David.
A couple of comments to add on here. Jimmy makes some good points. I think another way to tell, how these companies feel about their stock prices is their share buyback activity.
Right.
Because again, if our stocks are trading at such a deep discount, it's better off we own it, and let's try to reduce the share count. Secondly, one common theme we heard from a lot of the management teams is that the capital markets are starting to reopen for the REITs. The debt markets are slowly opening back up. A couple of guys have done some forward offerings, equity offerings. And so you are starting to see the capital markets guys tiptoe back in there, seeing some opportunities. Again, if you've got a stellar balance sheet, these guys are seeing stuff priced at around, remember the 10-year where it's at, based off of called 100 to 150 basis points above the 10-year. So we're hearing, quotes of anywhere from 5 to 5.25 for some of these guys to access capital, which compared to just, say a few months ago, isn't too bad. And so, there is opportunities that are out there. But again, to the bigger picture here, with no transactions really happening, discounts trading to discounts, we have this long way for this to kind of play out. But this could be a good way to hopefully play into the recovery should the markets turn.
Right. That makes a lot of sense. So let me ask you this. So one thing I've learned from you guys is it seems like one thing you can watch for, like we talked about, what's so cool about listed real estate, it's real estate where it meets financial markets, right? Like oil, it's where, it's a physical commodity that has to be physically delivered, and it's where it meets the financial markets. It's very interesting. What you can watch is like these transactions, right? Like you guys have said, which are down significantly. But let me ask you this for our viewers, and maybe it's for me, so quite honestly, so I can understand better. So when you're looking at the transactions as they do play out, like we talked about MPW's transaction in Australia last time, what investors are looking at is implied cap rate versus the cap rate of their current portfolio. And this is a statement. This is a question phrased as a statement. So what investors are looking at is implied cap rate and how that relates to their current portfolio. And a higher cap rate equals distress, basically, or it equals, maybe not distress, but it equals it's a suboptimal transaction for them. Am I on the right track there? Or how could investors look at that for data points on their portfolio?
David, you want to take a stab at it?
I'm trying to process the question.
Maybe I'll start first. Again, I got some general thoughts, right?
Yeah.
And because there's a lot of ifs, and the devil's always in the details.
Right.
What you're going to find today is that properties that are selling, especially if they're lower quality, especially if there's, operational or thesis impairment, the in-place cash flows are not reliable. The buyer is not buying in-place cash flows. And frankly, I think the seller, we're coming to a point where if the seller is coming to Jesus and they're, factoring capital markets, leasing costs, vacancy, what have you, even just market assumptions, right? GDP growth, all that stuff. There's a lot of, you can make the numbers work however you want to work. If a transaction is super simple, triple net lease, 30-year, if it's a bond proxy, that is a little easier to do the math on. But if you have an office asset, if you have an industrial asset, even industrials, right? This is one of the hottest property sectors of the last decade. We all know about e-com, Amazon, what have you. 2 years ago, these were, 3 cap assets with 35% net effective growth, right? You had peaking rents, peaking occupancies, and all that stuff. And now, again, at the top line, rents continue to increase. But are you going to, if you're a private equity buyer, are you going to model in 97, 98% vacancy? And the tricky thing, I think last time we touched about technology revenue management. Over this last decade, that the public companies and the larger operators have done an incredible job of squeezing out every last dollar. And when you get to these kind of, the hotel analogy is a compression night, right? It's a night where the room trades for $1,000 a night because you're completely full, right? There's one room left. You can price it wherever you want to price it. As you get from 95 to 96, 97, 98, your concessions go down, your turn costs come down, your pricing power improves as a landlord. So if we're underwriting an asset over the next 3 to 5 year period, all the strong property level operating margins that were a result of that rising tide, how much of that is going to unwind, right? The buyer probably has a much more conservative estimate for a 5-year hold period and an exit or terminal cap rate than the seller. So all these things go back to the bid-ask spread. But the truth is right now, we can be bearish, we can be bullish. There's a lot of room for in between, and that could be 50% of the asset value.
Yeah.
Jimmy makes a good point, because it reminds me of some of the stuff we heard at NAREIT. We talked to an apartment REIT who, LA, the rent eviction moratorium, all that stuff has moved to the rearview mirror now. And so these guys are evicting tenants. And they cited an example of this tenant who, I guess she was the daughter of let's say a Goldman Sachs executive, and she said she refused to pay the rent. And they went on, like, they found her Instagram page, and she's luring around like a Birkin bag and something, like all this stuff. And they're like, dude, you got the money, get out. Like, they literally kicked her out, and she paid up. But another example was, I believe, the same apartment REIT, they're going in and doing maintenance on the units, and they wound up finding, like, I think it was like 1,500 different pets that weren't accounted for on the lease agreement, which wound up being like an incremental $500,000 of revenue that they've been able to recognize for additional pet deposit fees. One of the guys asked, is that already in your guidance? Like, again, because that's going to have a serious, again, 500,000 isn't really that big of a game changer, but that's found money.
Straight
And
to the
so,
bottom line. Yeah.
And that's 100% NOI margin.
Yeah.
and so whether it's a pet deposit, a smart thermostat inside a unit, metered lighting, or whatever it is, these guys are trying to figure out every single angle possible to deliver the most bang for the buck and drive the most to the bottom line as they possibly can.
I love it.
Oh, one other thing to focus on is insurance. That's another thing that a lot of folks have been talking about, especially on the residential side, because of the premiums that are going out. Some of these numbers that we're hearing, and a lot of these guys have priced in some of these big increases, but that's like, again, when you think about expenses, insurance, salaries, insurance are like number 1, 2 when it comes to the big picture here. So, there's always this overhang with where's insurance going to go.
Yeah. Okay, one more shot at this, or maybe this is a fun thing to try to pull on is, so back to the perfect trade, and full disclosure, like I don't work at a pod shop, like trust me, I'm far from it, and I don't long short everything, pair everything. In fact, sometimes, especially this year, it's been a great way to lose your ass on both sides of a trade. So it's not about you don't have to set up everything like your Johnny Pod shop, but it is fun to look for shorts against your longs and vice versa. And so thinking of it that way, if you're looking at coming in and recreating, again, I mean, this is the simplest trade thesis, I think, in the world. Like, look, these two things are correlated. This one went down and this one didn't. So how do we, and again, so obviously it's hard to short your home. It's hard to short commercial real estate that's owned by moms and pops. Is there, so we want to buy the orange line, get that. How do we get short the blue line? Is there you don't have to say tickers or anything, but are there private REIT stocks? Like, are there companies that are custodians of private REITs that trade? Can we short? I mean, shorting Blackstone's seems like a kind of a that doesn't, I don't know. But anyway, I was curious, either you guys have thoughts on getting short this blue line? Any ideas?
My last point on that blue line is, again, when you look at the secondary private equity market, you're at a 20 to 30% discount if you want to sell your LP stake. So effectively, I'm not saying there's parity between where the public market discounts are to the private REITs, but if a person is gate kept in B REIT and they really want to get out, they're not substantially saving money. They're getting that public mark.
They're not getting one. They're not getting $1.
They're not getting $1.
They're getting 80 cents.
They'll save on the management fees, right? They're not going to pay 2-3% on an inflated NAV anymore. But and then they have that reinvestment risk to consider. A lot of these larger funds have their institutional consultants that drive those decision makers. They've got those pension funds that don't want to deal with the headache. And money speaks. You're in it together. No one wants to be, if you're the LP and you kind of break rank and you do something drastic and you make your colleagues look bad, and real estate is a small world, good luck getting in on the next deal. There's a lot of, memories that die hard.
Yeah. What about you, David? Do you have any thoughts on, you gotta be careful. Do you have any thoughts?
I think out of respect for everything that's here, I'm probably going to deflect on telling you ways to short the private real estate, because the answer is I don't know. Unless you frankly short, as you mentioned, short Blackstone, short Starwood, short Ares, or some of those guys. I don't know if you can. The other idea is potentially just buy a put.
Yeah.
Buy a put option on one of the parent companies, and that's your hedge. Again, the answer is I don't know. And probably not best for me to comment on how to do that in the first place.
Yeah, but what you are doing is giving people an opportunity to invest in the orange line in a pool in a great, fantastic potentially product. Cool. And so maybe we can just wrap on that. Like, so within REITs in general, we talked about this a little bit, but what are you most excited about? Let's close on both of you guys within real estate from here. Just tell, maybe some thoughts on what you're most excited about and what you're looking for before you get and if there's any catalyst to get even more incrementally more excited about that asset, that subsector of real estate trusts.
I'm gonna go galaxy brain on you a little bit here. Okay.
Let's go.
When I look at a company like Hudson Pacific Properties, office REIT, studio exposure, the writers are on strike. It's a 20% dividend yield that might get cut. You're in all the bad stuff, right? So, a couple things have to happen first for me to get more bullish, right? When I'm looking at these companies that have gone from 20 to 30 to 5, and they own good assets, they have good management teams, and they're decently well run, I need to see some broader macro signals improve. I want to see, right now we're, at 13 VIX. Are you kidding me? We're at 20 on the RVX for small caps. Again, whatever is happening in this market, if I'm looking to high yield to short, or if I'm looking at the debt market for distress, if I am a longer term allocator, even an opportunistic, allocator, I'm willing to forego some of the upside to limit my downside. And whether it's technical analysis, whether it's macro or fundamental analysis, there's not much that gets me excited on the long side today. But that doesn't mean that I won't be excited in the future. That doesn't mean I don't have that list. I'm building my list now, right? I'm building my list of companies I like that I know are going to stick around, that are not zeros. And frankly, the market can't make a proper determination, based on how deep our recession is or what things might play out to be. At any given moment in time in the last cycle, there were days where the CMBS market went zero bid. So how do you price an ETF like HYG when there's zero bid, right? You have these massive swings and no one can time the bottom of the market. But I'm looking for a series of fundamental and macro, scenarios to play out. And then I'm going back to that high quality REIT list, and I'll forego the 200% upside, but I'll hit some doubles. And, and I know, to David's point, there are good properties, and there are good companies. And if you have a 3-year time frame, a 5-year time frame, my money is today that if you bought Hudson at 5, that you're going to do all right.
Look, I completely agree with what Jimmy said, and I'm not here to say buy, sell, hold. I know we spent time talking about Hudson with the dividend cut and everything, and what's the long-term view of what, let's say, Hollywood looks like, or the motion, the writer's studio, what that looks like in the future.
Right.
But let's take it from a much higher level, okay? You commented that you went surfing, Colonel, and you may go back out there this weekend.
Yeah.
Which means you probably went to the strip center to go get your board fixed, waxed, whatever. You got a surf shop that you go to. That surf shop is probably a tenant of a strip center REIT. Chances are Jimmy went and got a cup of coffee this morning at Pete's or something like that. Like, we're using these properties every single day. Up cycles, down cycles, recession, depression, prosperity. We're interacting with these properties every single day.
Right.
It's our job to bring the best of the best to the public, regardless of if it's a Hudson Pacific, focusing on the big picture, what that looks like 10 years from today, or if it's focusing on a 99-year ground lease that somebody like Safehold owns. Again, that long-term perspective. But with us interacting with these properties every single day, I say ignore the day-to-day noise that we see in the news and focus on the big picture. Jimmy talked about investment horizon. We all have different investment horizons. Are you a 1-year investor? Are you a 10-year investor? Or are you a 1-day investor or a 1-hour investor? Based off of all of those metrics, each person has different principles and motives that are in place. And so as a result, I think if you are a 10-year investor, you need to focus with a 10-year mindset and not what we're seeing on a day-to-day basis in the news, if that makes sense.
100%. No, I love that. And I think there's something I love the ideas you guys both give. I mean, I think that's Jimmy's idea, or, to pair what Jimmy said about the high quality list. That's intuitively where I'm the shopping list I'm trying to bring. or that makes a lot of sense to me. And the other, in an ETF like PRVT or HAUS or XLRE, however you play it. Look, if you're buying an ETF, you don't have to worry about zero risk, right? Like, if those all go to zero, we've got bigger problems, right? And
Dude,
so
Turtle,
those are,
you nailed it. You nailed
yeah,
it because it's for private, it's 50 stocks.
yeah,
The
yeah,
chances of 50 stocks going belly up, again, I can't say the word guarantees and all
yeah,
that stuff. Dude, we know what the chances are of that.
right,
Versus, what's more likely, Hudson going to zero or the 50 constituents of the ETF going to zero? And I'm not saying
Yep.
Hudson's going to zero, clearly,
yeah,
because again, the sum of the parts is greater than the
yeah,
whole. This is where buying opportunities jump out, whether it's frankly Blackstone taking Hudson private, whether it's Highwoods buying Hudson because they want to expand to the West Coast. I'm not saying that there's anything in place, but this presents opportunity. It's the same thing about buying, again, hotels and airlines after 9/11. It's buying hotels and airlines during COVID. If you're willing to take some risk and take some pain for the long-term big picture, some of these names could be paying out handsomely, like I said, 5, 10 years down the road, where you look back and you're like, that was the easiest trade I ever made in my entire career.
100%. Yep, you do it with
I can't
ETF.
stress that ETF and single
Yeah,
stock enough, right? Because people
yeah,
thought that First Republic Bank was a steal at
right.
40, at 30, at 20. But if you're all in on one company and it goes to zero, well, there you are.
And that's why I caution investors against single stock ETFs, because
Yeah,
again, those vehicles are not geared towards the 10-year investor. That vehicle is geared towards the 1 day/1 hour investor, right? And so again, it goes back to know what's under the hood of the car. PRVT may not be for every investor. I sure hope it is. House may not be for every investor. I sure hope it is. But again, it's on the investor themselves, frankly, to do their own due diligence. And I say this with all due respect, Turtle and Jimmy, but just because we're talking about this on a webinar and you guys are watching this on YouTube or whatever channel, you still need to do your own work and do your own research.
yeah,
Just because Jimmy and Turtle tell somebody to go and do this, it's up to the end viewer to go and do their own work on this. Because what makes something a buy to you, me, and Jimmy may be a complete sell signal to Mary, John, and Tim. So, no two investors are alike. We could think Hudson's a buy, and there's 10 guys who be like, dude, that's the biggest sell I've ever seen. Who's right? At the end of the day, the market will tell us who is right.
yeah. I love that. I think it's a great place to end it for today. Let's come back and pull on this again sometime, David. We really appreciate having you on the show. I think those are two very interesting ETFs to consider. Like you said, do your own homework, not investment advice, blah, blah, blah. The other thing is that these are ETF ideas for you, and maybe each is a little small sliver of your portfolio. But more than that, because I think no one ETF, no one trade idea should be too big of a piece of your pie. That's all nothing too controversial there. And then, but with that said, Eric Basmagian, housing, which we're not talking just about housing, but housing is the economy. Eric Basmagian, and a great econ guy on FinTwit. And I believe that. And I believe that housing price appreciation is part of this is what I believe. I don't know if it's true, but I believe housing price appreciation that the average American experienced during COVID is part of what's keeping this whole thing afloat. Maybe. I mean, I don't know. But so the point is, I think there's interesting trade ideas here we talked about during the last 40 minutes or so, 45 minutes. But then also, this is just a really interesting, let's just close on this chart here. This is an interesting disconnect. These lines, like David said, nothing's guaranteed in this life, but these lines will come together. That gap will close. I don't know which one's going up, and I don't know which one's going down, and I don't know when. But at some point, these gaps, the math says these things are too correlated to just drift apart forever. So, so do something good for your country. Buy some REITs. Just kidding. But no, I think that it's a great thread to pull on, and this is something that I'll personally be keeping an eye on. Any closing comments from the panel here? Thanks so much for your time, both of you guys.
I'll end and say that when I look at this one, this is the rolling return, but the prior chart, when you look at the NAVs, there are not many scenarios where the public market is not inflecting sharply upwards and the private market continues to tread lower. So it's very likely that the REITs will bottom before private real estate, which is why I think, again, on balance, I'm bearish, because I think people will have to take their marks one way or another. And there can be feedback loops in there. But like I said, there's so many other confounding factors. So, and it's going to be policy driven. Does Jerome hold for 12 months, or does he capitulate? Right. And how does the short end of the curve going higher than what the market is currently expecting impact the longer term yields, which have been relatively steady? They haven't crept up north of 4. But what happens if they go from 3.8 back to 4.5 or 4.25? You can bet. This is a bet I'm willing to make that the public REITs probably won't like that.
Probably not. Yeah. No, and I think that's very well said. David, closing comments from you?
Thanks, Dooming Cloud over there. I appreciate all that.
You're a friend of the podcast. I can be honest, right?
All that wonderful upbeat outlook as I'm launching a fund next week. Thank you so much. But you're right. There's so much. Again, the only thing that's certain in this world is uncertainty, and we have a lot of uncertainty that's going on out there right now. I think next week's meeting is the most important Fed meeting since the last one. I mean, I know I say that sarcastically, but
this is a big
we're really in for some fireworks. I think next week, as well as the one in July. We've got CPI coming out. We've got PPI coming out. Every single report that hits the tape right now is being so closely scrutinized, looking for any signals. And for us in the world of real estate, dividend sensitivity, 10-year, as Jimmy said, if we go from 3.8 to 4.5, the public REITs aren't going to like that. Because the dividend yield number disappears, that advantage of REIT dividends versus fixed income dividends. All these moving pieces, kind of hinge on this. And so I think at the end of the day, though, it goes back to what I keep hammering on. You got to focus on the big picture. You got to focus on the investment. What's my goal for this particular investment? Am I looking to make a quick buck, or am I buying this in my portfolio for the next 50 years because I believe in the mission of the company, the sector, the story, whatever it is? No two investors are alike. And so we can't react emotionally with the news. If you see the markets down 1,000 points in a given day, you can't react emotionally. Key, don't put money you need in the market. If you need the money, keep it in your account. Don't put it in the market where it could potentially go away, right? So, money in the market, you should, as an investor, we all focus on wealth preservation, but you also kind of have to be prepared for it to kind of sometimes go the other way, which is what we're seeing on the chart here. But I'm also a believer of that which goes down must come back up. And so at some point, you would expect this correction. If I knew the answer to that, no offense, guys, I wouldn't be here. I'd be partying in Hawaii on my jet right now.
You'd be on CNBC.
We don't know when that recovery. That too. I'd be the truth sayer. But more importantly, we know what's happening right now. We know that multifamily remains strong. We know that industrial remains strong. We know that data centers and towers remain strong. We know that the net lease guys will remain strong. Again, a lot of these sectors are just humming along, and they're ignoring where the 10-year treasury is. They're ignoring where the federal funds rate is, all that fun stuff. They're focusing on operations. And sometimes you as the investor, you need to focus on that as well. Is the company doing what they are set out to do? Are they doing what they promised to deliver? Are they raising the dividend? Are they growing? Are they looking out for me as the shareholder in my best interest? And by and large, at the end of the day, the answer is yes. That's what all these companies are focused on.
I love it. Beautiful place to leave it. When Jerome talks next week, one thing you can know for certain is, like David said, he doesn't know either, right? Nobody knows how this plays out. I promise you, we're not the only ones watching this disconnect in this little market called real estate, right?
Jared, wait, Turtle, does that mean Powell's watching this as well? He's watching us talk today?
I believe so. I think so. After the and I mean, why wouldn't he, right? I mean, collectively between you and Jimmy, I mean, that's a lot of REIT firepower in one Zoom room. So he should be. If he's not, he should be. And for you guys that made it to the end, thanks so much for watching Swami Research and the Real Assets Weekly. David, thanks again for coming on. Jimmy, great talking to you. And you guys have a great weekend. And thanks so much for watching.
Thanks, buddy.